Software stocks are under pressure. SaaS names are selling off. Growth is slowing, and AI is starting to disrupt entire business models. Investors are asking a serious question right now. Are software companies in trouble? Is AI going to replace traditional SaaS? Or are there exceptions? Because while many software stocks are struggling, one company just reported 30% revenue growth, signed its largest deal in history, and says it sits at the center of the enterprise AI revolution. That company is Snowflake. So in this video, we're going to walk through Snowflake's latest earnings call, break down what's actually happening inside the business, and most importantly, we're going to see whether Snowflake software is truly different from the rest of the SaaS space, or if it's just riding the AI wave like everyone else. Let's start with the numbers. Snowflake reported fourth quarter revenue of $1.28 billion, up 30% year over year. Product revenue, which is the core of the business, came in at $1.23 billion, also growing 30%. For a company already at this scale, that's strong growth. But the quality of that growth is even more important. Net revenue retention came in at 125%. That means existing customers are spending 25% more than they did last year. In recurring revenue businesses, that's a powerful signal of product stickiness and expansion. Snowflake also added 740 net new customers this quarter, up 40% year over year. And now 733 customers spend more than $1 million annually on the platform, a 27% increase from last year. But the number that really stands out is remaining performance obligations. RPO reached $9.77 billion, up 42% year over year. That's future contracted revenue already locked in, not just strong sales, but real visibility. Now here's where the separation in software stocks starts to become clear. There are software companies where you still have to do the work. They give you dashboards, buttons, workflows. AI might help you move faster, but you're still the one operating the system. And that's where those companies become vulnerable. Because if AI can automate the task entirely, why would you need the traditional software layer at all? That's the risk many SaaS companies are facing right now. Snowflake, however, is positioning itself differently. It's not just providing tools. It's moving toward a model where the system does the work for you. AI agents built on Snowflake can analyze data, generate insights, trigger actions, and automate workflows. Instead of opening dashboards and manually running reports, the agent handles it. That's not an incremental improvement. That's a structural shift. Some software companies are being enhanced by AI. Others are being replaced by AI. Snowflake is trying to become the platform where AI actually runs. And if enterprises move toward AI-native workflows, then the infrastructure layer powering those workflows becomes incredibly valuable. And that's where the enterprise commitments start to matter. This quarter, Snowflake signed its largest deal ever, over $400 million in total contract value. They also signed 7 nine-figure contracts in Q4 alone. These aren't pilot programs. These are multi-year commitments. And that $400 million deal came from an existing large financial services customer. This wasn't a startup experimenting. It was a major institution doubling down. When enterprises commit hundreds of millions of dollars, they're not betting on hype. They're betting on infrastructure. And that brings us back to RPO. Nearly $10 billion under contract, up 42%. That's long-term confidence. So let's zoom out. Software stocks are under pressure because AI threatens traditional workflows. If AI can do the job, why pay for the old tool? That's the fear driving many SaaS sell-offs. But Snowflake is trying to position itself on the other side of that equation, not as the tool being replaced, but as the platform powering the replacement. It's replacing legacy tools internally. It's helping customers build AI-native systems. It's signing massive long-term contracts. And it's still growing close to 30%. That doesn't look like a company being disrupted. It looks like a company trying to power the disruption. Now, will everything go perfectly? Of course not. AI competition is intense. Margins will need to improve over time. Enterprise spending can fluctuate. But if a separation is happening in software, between companies threatened by automation and companies enabling automation. Snowflake is clearly trying to be in the second group. And that's why this stock is so interesting right now.